The two corrections were very different in nature. The dot-com bubble was a real technology correction, and you lost 90% on Cisco shares at the time. For private equity, learning was very much on the venture side. Fast deployment of venture funds proved to be very detrimental when it was just before the correction. So late stage venture in 1999 and 2000 was a terrible outcome at the end. In the GFC, it was a completely different setting. Venture market did not suffer at all, while the large buyout space with the higher leverage applied to their businesses took a significant hit. And everybody was afraid of the wall of maturity that followed that space, that time. It turned out much better than assumed in the trough of 2009, also thanks to the reducing interest rates post the crisis. I think there's two experiences that are really worth highlighting here. First one is monitoring the fundraising dynamics for each segment and region and sub-area specifically, and looking at the developments of that. The second one is really quality of businesses and quality of investments as general. So on fundraising, we have developed even through our learnings a fundraising indicator, which really maps fundraising and models the fundraising dynamics to see whether there's too much dry powder in a certain investment area. And the most important thing about this is to avoid pro-cyclicality. So don't commit too much money into an area where fundraising is very high right now. That's the philosophy that we take away. The second one is then quality of investments and quality of underlying individual businesses in general. So the quality always wins in the long time, right? That's really the two main takeaways. Well, we are coming from a very euphoric 2021, where fundraising dynamic was high, realizations were high, distributions to investors were high, valuations were high, and new investment activity was high. So everything was very high. So we've gone through 2022 correction, and today are in a market where investor appetite is cautious and reserved, let's put it that way. And that means overall this is a healthy environment to invest in. One thing is that some people think of the investment market as an efficient market, and private equity is definitely the market that evidences that investing is not built on an efficiency theory. And then the second thing probably is that the media is covering private equity very much with regards to large mega buyout topics and the mega buyout funds. That's only one segment of the market. It's a big one by capital, but the real beauty of private equity is in the smaller businesses into venture capital, which is often seen as part of private equity, and then we say buyout and venture combined are equal to private equity. The nomenclature of that is a bit different in all regions in the US and in Europe, but that's really how we look at it.